Today we're doing a video on bonds on TLTW. I had a few subscribers reach out and ask if I could do comparisons on certain bond funds now that interest rates are possibly falling. And then today we got a good jobs number. Well, however you want to perceive good, we're softening in the jobs market, and that's good for interest rates as they should continue to fall as the economy weakens. Normally you want to see strong jobs, and that's a sign of a strong economy, but our economy is too strong right now and inflation's too high. So when you get a weaker number, that's almost a positive, a blessing in disguise, because now the Fed has to lower rates. So bonds would be a big beneficiary of falling rates, because as rates rise, bonds fall. As bonds go back up, they usually go back up when rates fall. They have an inverse relationship. We make $104,000 per year here in dividends. We're always trying to get this number up, as I say. So bond funds are a great way to do that. TLTW, let's look into that. TLTW, it has a double-digit yield, I believe, and it does 20-year Treasury bonds. So it has high-quality holdings, no doubt about it. It's the government, which is the safest asset you can buy pretty much when you hold it till maturity. But daily, these things are very volatile as interest rates make their price fluctuations wild. So you don't want to get caught buying and selling bond funds in the open market. You want to just hold them until maturity. That's real actual bonds. Hold them to maturity. Now, these bond funds, TLTW, it's a buy right. So yes, while it has a high dividend yield, I'm not going to do the math on this fund because I just want to get to the most important part about the fund, TLTW. Okay, it sells covered calls, so it's going to cap its upside. So if the bonds fell from rising rates, which this fund definitely fell pretty significantly, just like all other bond funds, its ability to rise back with those other bond funds is muted because it does buy rights. So it sells covered calls, buy rights, sells covered calls. So even though they put the strike price about 2% above the current market price, which is nice in this fund, TLTW, I got this information from Seeking Alpha. Even though they put the strike price 2% above, you're not going to get all that upside back to the old highs, because when they sell those calls, when you sell calls and they get called away, you take losses on those, and that caps the upside in the fund. So TLTW also, it sports a duration of 17.3 years. I got this from Seeking Alpha. So investors should expect capital losses of around 17.3% for every 1% increase in interest rates. It says expect significant outsized losses from small movements in rates. Again, I got that from Seeking Alpha. These are the most important points to be made on TLTW and HYGW and LQDW. TLTW has the longest duration, so it's the most affected. LQDW and HYGW, they have less duration. But here's the problem with those three funds. They have high maintenance. So if we go to our portfolios and we check out our days, gains, and losses, you'll see that we're down 0.61. The market is down 0.34, NASDAQ 0.29, and S&P 0.26. So they're beating us today. However, really quickly, I'll show you that our performance value proves that we're beating the market overall. 16% we're up. Dow's up 0.6, S&P is up 6.7, NASDAQ's up 15.5. So we're still beating the entire market. Getting back to the subject, this is why I don't own TLTW, LQDW, or HYGW, because I own PTY. PTY is a corporate bond fund similar to LQDW and HYGW, except it has a little bit higher dividend than those, and it has a 5-star rating on Morningstar. So TLTW, this is its recent price action. But if we go to PTY, you'll see that PTY is 5-star rated on Morningstar. And it's gone from 10,000 to 30,000 over the last 10 years, which is nice. But 5-star fund, and its duration is much less than TLTW. The duration of this fund is, as you can see here, 4 years, just under 4 years. So this company, by the way, PTY, I've done a video on in the past. You can go check that out. But we reduced our amount in it, our position size recently during the SVB fallout, because we wanted less leverage, because we don't know where they're getting their loans from, because leverage is loans. They have 35% leverage here. But once that SVB issue was shored up and liquidity was injected back into the banking system, and then we got the indication for Powell that rates were going to start falling, that's when I went back into bonds. And the recession was going to come, quote unquote recession. So you go to safety for bonds. If you want safety, you go to bonds. And I went to PTY for its high ranking. So 5-star. It has all the other sectors that you would think that you need to have. It's fully diversified. PTY is my play on that. And to prove what I mean about the maintenance, let me show you. So PTY snapshot, you look at the maintenance, it's 40%. Whereas TLTW, the maintenance is 50%. And that's significant because I use a lot of margin, as I've showed you in past videos. That's what we do at this channel, 50%. Same for LQDW and HYGW, they are 50%. So this sucks up a lot of my equity, which is precious. I need my equity to stay high so I avoid margin calls. So as you can see, my equity is about 100,000. It's a little over 100,000. Okay, that needs to stay above 0 to avoid a margin call. While my account value may be 350 or so, it's about this equity level to not get to 0. That's how we avoid margin calls. So because our debt here is 280,000, so we're using debt charged at 5% interest, and if we're making 11% on something like PTY, then we're netting 6%. So I like doing this. This is my favorite way to make money. It blew away the S&P over the years. Again, we're making 104,000 off this process. If you go look at performance and value and you look at it over a 3-year period, you're going to see that I'm blowing away the market. And that's because, see, we're up 256%. Everything else is up, a fraction of that. And that's simply because I'm using leverage. It's not because I have magic trading techniques or anything like that. I'm just buying these conservative, highly ranked funds on Morningstar and just using the leverage to increase my performance. So that's how we're beating the market this year, and so on and so forth. So PTY, that's our fund. We also have GOF and RIV. GOF and RIV because they're 4- and 5-star funds, RIV and GOF. And they also have equities in them, a little bit of stocks and things like that, exposures, so that they get upside participation when the market goes higher. Unlike a TLTW, where its upside participation is capped, not only because it doesn't have equities to diversify, but it has covered calls, which caps its upside once again. So any covered call fund, I like it, but I like it more for the indexes like the S&P 500. Those are the videos we did last night. Covered calls on Madison and SPYIs. Check that video out. We also did covered call funds, Tesla and OARC, that have 55 and 60% dividends that pay you monthly. I like those covered calls because even if the stock falls, the dividends will pay back the asset in less than 2 years, because 50% times 2 years, that's 100%. So you're going to cash flow that asset. Same for PTY. The only reason why I'm choosing PTY is, again, it has less duration, so it has less volatility than a TLTW. It has lower maintenance, 40% versus TLTW's 50%. And it has a higher ranking on Morningstar. It has more history in it, 5-star ranking for PTY. So those are my bond plays: GOF, RIV, PTY, 4- to 5-star holdings. I like TLTW. I like the high quality asset that it owns in 20-year treasuries and things like that. If you're going to go corporate bonds, go with the highest quality ranking in PTY, in my opinion. HYG and LQDW, those are corporate bonds, and I believe PTY is the highest quality of those. And if you're going to go with covered call funds like TLTW, maybe go with something with more correlation and less NAV erosion, like more correlation to the markets and less NAV erosion to the duration that it has. So if you're going to sell covered calls, once again, look at these other facets, like go for ones with higher dividends, lower maintenance, or go towards the sectors that move back up in price, like the S&P, and therefore the upside isn't capped as much. So I hope this video was clear. If you have any more questions on these bond funds, let me know. Again, good time to get into bond funds because they move inverse to interest rates if you think interest rates are falling. So on TLTW, I really do like it. Thank you for that suggestion. For my margin, I'm using PTY because it's 40%. If you don't have margin, maybe TLTW is the ultimate, recovery play, as it's, the longest duration, like I was saying. Be aware of those covered calls, how they get called away. Look at these other bond funds if you still need to have bond exposure. Thanks a lot.